Welcome back to Iron Financial, the one place where we forge stronger portfolios by stress testing the market's biggest stories. Look, the AI gold rush is in full swing. And while everybody and their brother is chasing the gold miners, we're focused on the only thing that really matters: who is selling the picks and shovels. Today, that company is Marvell Technology. The stock's been on an absolute tear, and their guidance is frankly unbelievable. So our job today is to ask that one tough question. Is Marvell building an impenetrable AI fortress, or is this whole thing just a house of cards about to get blown over? Let's get to work and find out.
Okay, here's how we're going to break this down today. First, we need to establish the ground truth. Is Marvell really the AI titan everyone says it is right now? Then, Section 2, we're going to decode the jaw-dropping guidance that has the entire market buzzing. Third, we will get into the weeds of their $15 billion blueprint. And then, the most important part, Section 4, we are going to stress test the foundation of this entire story. We're looking for cracks. And finally, we'll give you what you came for, the Iron Financial Verdict. Let's dig in. All right, let's get right into Section 1, is Marvell an AI titan? You see, before we can even begin to look at their wild future projections, we have to analyze the foundation they're standing on today. You need to understand that Marvell isn't just some bit player. They build the critical, high-speed nervous system for AI data centers. We're talking about the interconnects, the switching, the custom silicon, literally the picks and shovels of this revolution. So our first job is to see if those tools are forged from solid steel or just cheap tin. Now, just looking at the surface, that foundation looks pretty solid. Their latest quarterly numbers for Q4 were strong. Revenue came in at $2.22 billion, just squeaking past estimates and growing over 22% year over year. Earnings growth was even better, up 33%. But the number that really, truly matters here, the number that's the absolute engine room of this whole company, is that data center revenue. $1.5 billion, growing at 21%. From this angle, it looks like the machine is humming along perfectly. But as always, that is not the full picture. Whoa, hold on a minute there. A solid beat? Let's not get carried away. Are we looking at the same chart? Yeah, they beat, but the growth engine is clearly slowing down. Look at the trend line here. This is the third straight quarter where growth has decelerated. So I have to ask, is this train running out of steam right when it's supposed to be leaving the station? To me, this looks like the first real crack in the foundation, and it's a huge red flag that we absolutely can't ignore. Okay, that's a fair challenge, a very fair challenge. The pass is slowing, I will grant you that, 100%. But the entire bull case for this company, the reason this stock has absolutely skyrocketed, it isn't built on the last quarter's numbers. It's built on what management says is coming next. So we're moving from the foundation that's already been laid to the architect's blueprint. Let's get into Section 2 and decode this guidance and see if it's really made of steel or if it's just smoke and mirrors. And here it is, the number that changed everything. For this fiscal year, 2027, management isn't just projecting a little bit of growth. No, they are forecasting a massive, unbelievable reacceleration to nearly $11 billion in revenue. Now let me be clear, that's not a small adjustment to a forecast. That is a complete and total rewrite of this company's entire trajectory. A number this big, this bold, forces everyone on Wall Street to stop what they're doing and pay very close attention. And this $11 billion forecast didn't just materialize out of thin air. Just look at the timeline. It tells a powerful story. Back in September, they started with a guide of $9.5 billion. Pretty good. Then in December, they raised it to $10 billion. Even better. Now, just 3 months later, they've tacked on almost another full $1 billion. This isn't just a static forecast, you see. It's a clear trend. Management is screaming from the rooftops that demand isn't just growing, it's accelerating at a pace that even they didn't expect. But they're not stopping there, not even close. If $11 billion is the new foundation for this year, then $15 billion is the absolute skyscraper they're promising to build on top of it. This is their target for fiscal 2028. Think about that. It implies nearly 40% growth in a single year. It launches Marvell into an entirely different league of company. This one number, $15 billion, is the central pillar holding up the entire bull thesis. Okay, whoa. Just stop right there. $15 billion? Are you serious? This is a company that just did, $2.2 billion in a quarter? This isn't bold, this is completely audacious. Frankly, this smells like pure, unadulterated hype designed to pump the stock price into the stratosphere. So don't just show me the headline number. I want to see the blueprint. Show me the engineering specs. I want to see exactly how they think they can build something that tall, that fast, without the whole thing collapsing. Challenge accepted. An audacious forecast like that absolutely requires an ironclad plan. And believe me, management didn't just pull this number out of a hat. They laid out the structural pillars that are supposed to support it. So let's move right into Section 3 and deconstruct this blueprint piece by piece. We're about to find out if the math actually holds up under scrutiny.
First things first, you have to understand the engine that drives this company. The data center segment, it's already nearly 3/4 of their entire business, 74%. This isn't some future hope, it's the reality today. The rest of their business, communications and other stuff, it's stable, but the data center, that's the high-octane jet fuel. For them to even have a prayer of hitting $15 billion, this segment can't just grow, it has to achieve escape velocity.
And here it is, the roadmap, the actual plan. And it's not one big bet on a single product. It's a multi-pronged assault on the market. Let's break it down. Pillar 1, data center interconnect. They're forecasting over 50% growth this year alone as the industry moves to faster speeds. Pillar 2, custom silicon. They see over 20% growth this year, and then they expect it to at least double the year after. Pillar 3, data center switching, which they see growing to a more than $600 million business. And finally, Pillar 4, acquisitions like Celestial and XConn, which are expected to layer on another $250 million in revenue. This is a detailed, diversified, and incredibly aggressive plan.
Okay, let's pause for a second and define a key piece of technology here. CPO, which stands for co-packaged optics. This is really cutting-edge stuff. In the simplest terms, it means taking the optical components and the switching silicon and integrating them into one single powerful package. So what's the benefit? It absolutely slashes power consumption and latency. Those are the two biggest bottlenecks holding back massive AI clusters. With their acquisition of Celestial AI, Marvell is targeting a $500 million revenue run rate from this technology alone by 2028. This isn't a side project. It's a massive bet on the future architecture of the data center.
And there's another key piece to this puzzle, CXL, or Compute Express Link. The easiest way to think about this is like a superhighway for computer memory. Right now, in most systems, memory is locked to one processor. It's siloed. CXL breaks down those walls and lets CPUs, GPUs, and all the other processors share one giant, efficient pool of memory. This is absolutely critical for training the enormous AI models of tomorrow. And for Marvell, it's a core part of their strategy. They want to sell high-margin silicon that attaches to everybody's processors, not just their own. It's a classic picks and shovels play, but for high-value silicon.
Okay. I have to admit, the blueprint looks impressive on paper. I'll give you that. But a blueprint is not a building. And now it is time for the real test. We're moving to Section 4, and we are putting this entire plan under maximum stress. We are actively, deliberately looking for the cracks in the armor. We're searching for the weak points, the fatal flaws that could bring this whole magnificent structure crashing down. Let's see how it holds up.
And would you look at that? Here's the first major crack. Days Inventory Outstanding, or DIO, just jumped from 92 days all the way up to 118. That is way above their 5-year average. Now, in the semiconductor industry, that is a classic textbook warning sign. It screams that demand could be weakening. It suggests they might have to start slashing prices just to move all this product they've built up. So what is it? Is this just sloppy capital management, or is this hard evidence that the massive demand they're forecasting is just a mirage?
That is the classic bear argument, and it's the first place they always go. But it completely falls apart when you actually listen to what management said on their earnings call. They were asked this question directly, and the CEO, Christopher Koopmans, his response was crystal clear. He said, "We have secured the supply that we need for all the growth." This isn't a sign of weak demand. It is a strategic necessity. You can't build a $15 billion skyscraper without stockpiling the steel first. They are not stuck with inventory. They are building a war chest for a pre-sold boom.
Fine. Okay, fine. Let's say, for the sake of argument, that I accept the inventory story. That brings us to an even bigger, much scarier risk: customer concentration. Their entire custom silicon dream, the business that's supposed to double next year, is built on the whims of a handful of giant hyperscaler customers. That's not a business model. That's a tightrope walk over a canyon. What happens when one of those giants decides to pull back spending or design their own chip? Marvell's entire growth story catches pneumonia and dies. Wrong again. You're looking at the surface, not the underlying structure. Their strategy is what we call diversification within concentration. They're not just selling one widget to these giants. They are deeply embedded, deeply engaged across multiple product lines with all of them. Switches, interconnects, custom silicon, you name it. And they're not sitting still. They have over 20 new custom design wins that are layering in over the next 2 years. They are deliberately making themselves so indispensable across so many critical areas that losing them would be more painful for the customer than it would be for Marvell. It's a brilliant strategy. And now for the final stress test, the balance sheet. Can they even afford this incredibly ambitious plan? Well, the numbers here speak for themselves. The key leverage ratios are rock solid. Total debt is manageable. Gross debt to EBITDA is a very healthy 1.38 times. But look at net debt to EBITDA. It is barely above half a turn. This is not a company stretched to its limits. This is a company with a fortress balance sheet. They have all the financial firepower they need to execute this plan without even breaking a sweat. This isn't a weakness, it's a weapon.
So there you have it. We've examined the foundation, we've decoded the blueprint, and we have put that blueprint through the toughest stress test we can. And that brings us to the final weigh-in. Section 5, the iron financial verdict. It all boils down to one simple question. Is Marvell Technology an opportunity, or is it a trap? Here's the entire debate laid out on one single slide. The bull case? This is a fortress of growth, built on staggering forward guidance, a dominant position in multiple key AI segments, a secured supply chain, and a rock-solid balance sheet. And the bear case? It's a house of cards, built on hype, and it's threatened by decelerating historical growth, those rising inventory levels, high customer concentration, and massive execution risk. So which is it? A fortress or a facade?
This is our path to conviction. Let's walk through it. Step 1. The risks are known, and in our view, they have been neutralized. The bear arguments about inventory and concentration are absolutely valid points to raise, but management has provided credible, direct, and convincing answers. Step 2. This growth is secured. This isn't just a speculative guess. It's based on firm purchase orders and record bookings from the biggest companies in the world. It's as de-risked as a forecast this enormous can possibly be. And that leads directly to step 3. The valuation has a foundation. Yes, the stock looks expensive on today's numbers, but the company is poised to grow into that valuation at a blistering, almost unprecedented pace.
And that brings us to the final word, the iron financial verdict. After putting this company through the forge, after stress testing every beam and every rivet, we believe its growth plan is structurally sound. This is not a house of cards. What we're looking at here is a potential portfolio cornerstone in the making. The risks are known and they are manageable, but the blueprint they've laid out is one of the most compelling and well-supported in the entire AI infrastructure space. So the final question isn't really about Marvell. It's about you, the investor. In this historic AI gold rush, are you going to chase the fleeting glimmer of hype? Or are you going to invest in the foundational steel that makes the whole thing possible? Our analysis shows Marvell is forging the steel.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.